Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we are talking about another lending opportunity. We've got on the podcast today Jeff Grobaski from Epic River. And Jeff is going to kind of walk us through what his group does. And just to me, it was another commercial lending opportunity that we hadn't seen before. So we just thought it might be interesting, if you're in that space, to spend a couple minutes with us and see what this is all about. So without further ado, we'll get Jeff on the podcast here. Okay, welcome back to Bank Talk. Today I have with me Jeff Grobaski. Jeff from Epic River. Jeff, thanks for joining me today.
Absolutely. Thanks for having me, Charlie.
And so are you the founder or the CEO or the janitor, or what do you do for a living over there?
You might have to tell me the difference between CEO and janitor, but all of the above. I was one of the founders. I had two co-founders, and I've been acting as the CEO. And if, whoever's closest to the broom sweeps.
Okay, good. So today I wanted to talk about patient lending. And I think I'm using that term right. And This is different than just being a patient lender. So if you could just give me a little feel for what Epic River does for a living, and then maybe a better feel for what this patient lending thing's all about.
Yeah, absolutely. So Epic River was born to provide digital lending services to community banks and credit. We initially focused on e-sign and then expanded to remote notary and then online applications. And as we moved our way through that digital lending customer experience portion, we recognized that there was an opportunity for us to be a little bit different than all the other digital lending players out there, in that Epic River doesn't just bring the software, we also bring the loan flow. And so we want to identify strong, low-risk lending opportunities for the banks that are utilizing the platform. And it's really been a kind of a fun thing for us. As we find good opportunities, we then turn around to our banks and say, here's a great opportunity. It's a little bit selfish for us because, we make money by our community banks using our platform. But also, we're bringing an opportunity to a community bank or credit union that maybe didn't know it existed. And patient lending is a perfect example of one of those loan flow opportunities. It's something that would be very difficult for a community bank or credit union to do without a platform, because it's a lot of small loans. And so by using a piece of software to streamline the entire process, everybody wins, and it's a good community play too.
Okay. So could you walk me through a use case, would you? When I think of patient lending, I think of, I went into the hospital, I got injured, I can't pay the entire bill. Insurance is involved somewhere in there, and eventually it becomes a debt outstanding to myself. Can you walk the patient workflow, if you would?
Yeah, sure. And that is exactly the scenario, right? So sometimes you plan for healthcare, but most of the time you don't. And so if we take an example, our average loan size is just over $4,000. So we'll say you've got a $4,000 bill. So you're home now, you're recovering, and you get a bill in the mail and it's $4,000, and you don't have $4,000. And that's where the problem starts. Traditionally, hospitals, healthcare providers would offer some form of an internal payment plan. And so you would get that bill, and your option would be cash, check, credit card, or give us a credit card and we're going to hit it every month for 12 months. And we're going to just divide your balance up by 12, and that's what you're going to pay. So in that scenario, you're looking at paying $350 a month. But a lot of people see that $350 a month, they say, still doesn't fit in my monthly cash flow. It doesn't work in my budget. So if the healthcare provider doesn't have any other options, that's when somebody ends up in collections. And then if collections doesn't work, you end up, buying the medical receivable way down the line. And the healthcare provider doesn't make much. It's very damaging on the patient, and it's a bad experience all around. So when healthcare providers have our system, it puts them in a good place, because now they can offer cash, check, credit card, or a loan. And these loans are offered in two ways primarily. One is on your statement and on the website, you can click as a patient and sign up, and we integrate into the hospital system and we pull that patient balance. So we know how much you owe and we can get that loan set up and get your bill paid. The other option is via phone, right? So when oftentimes if you have a bill and you don't have the ability to pay it, people call in. What do I do? And this is where the healthcare provider now, instead of just saying, give me your credit card, they can say, we have an option. It's a loan program. If you can pay your loan off in 2 years, it'll be 0% interest. You won't pay any extra. If it's longer than that, there'll be a 10% simple interest charge on it. So taking that $4,000 and say a patient signs up for 4 years, they'll pay around $100 a month for 48 months. And they'll end up paying about $800 in interest. But that payment will be $100 a month. And if that fits in their monthly cash flow, that's the definition of affordability. If I can make the payments, it's affordable. And so that's really where we like to play is we go down as low as a few $100s for a loan balance and up to about $10,000.
Okay. All right. So you have so you've got a range in there that you're comfortable with, or you found more likely to pay or something along those lines.
That's right.
Okay. All right.
So
go ahead.
So we're just the platform in between. The healthcare provider has the bill. We collect the patient information. We close the loan, and we deliver the closed loan to a local community bank or credit union.
Okay. So at the time, and this is another question that I have is, if I have a hospital loan, Charlie's got a loan. Sorry, not a loan. Charlie's got a debt due to the hospital, right? I don't necessarily pay interest to the hospital. I don't think so I'm taking this loan on knowing I've got now a loan with XYZ Bank. And then based on that, I'm willing to pay interest because of the payment plan. Or the other scenario that comes to my mind is I've got a bunch of credit card debt. And right now I stack another $4,000 on that or some number. It's just going to my balance every month, and that's at 25%, where this might be a lower number. That's right. Okay, that's really fascinating. So let's talk about the relationship with the bank. I'm assuming that the bank relationship that would be most successful would be I'm in a town with a healthcare provider, and I want a bank that's local to the healthcare provider, right? Because there's some value to the banker, I would think, to have those account relationships. You might be stealing Chase Bank's customers, or at least starting a relationship with them. If you're getting a loan, fits outside of the primary relationship. Is that fair? I mean, is that?
Yeah, absolutely. So we do like to make it a direct relationship. So one hospital with one bank, and that way that bank is local. Oftentimes there's bank presidents sit on the board of the hospital, and the hospital CEO sits on the board of the bank. So there's a lot of familiarity and trust in how those patients and the members of the community are going to be treated. And there's a common goal, right? If the bank leaves the community, it's bad for the community. If the hospital can't stay open in the community, it's really bad for the community. So the two have a vested interest in not, sapping every penny out of the community, but keeping them healthy, both financially and physically.
Okay. So how are you building this business? Are you knocking on the bank's doors as well as the hospital's doors?
So we're traditionally selling to banks. So when we get a bank on our platform, we then introduce the program to them. We explain how it works. We provide all the materials. We'll brand it for them. And then we coach them up on how to have the conversation with their local healthcare providers. Because their lenders are often looking to get into those healthcare providers. And now they have something new and unique to have that conversation. Instead of just, walking in and asking if they need a new equipment lease, this is something that nobody else is talking to them about. So we coach the lender up on that. We'll help them through the first couple of conversations so they understand, how to overcome the objections that might come up and how the program works and what the value prop is for the healthcare provider. And so effectively what we're doing is we have a large network of banks, and we're enabling them to go out and sell this new lending option into their community.
So how does a bank throttle the number of lending opportunities per hospital?
So the program has some pretty good natural governors on it. One of them, the healthcare provider is actually guaranteeing these loans. So they're going on the hook. And so there's a pretty easy, straightforward conversation that happens, but also initially we'll deliver financial information from the hospital to the bank, along with here's what our data says this bank or this hospital is going to need from a loan volume standpoint.
Okay.
And then the bank will set a maximum amount of loans that the hospital can have outstanding at any point in time. Typically, it's not much of a problem because as the loans are coming in, so are payments on previous ones. And the balance typically stays pretty steady state once the program's up and running.
Gotcha. All right. So what if the throttle's reached? I would assume then that you just don't make offers to the patient.
So if it kind of becomes a decision between the bank and the healthcare provider, do they want to extend and do more? And so far, every time we've hit it, we've bumped up against that. That's been the answer, because we don't hit it in year 1, 2, or 3. It's usually like year 4 or 5. And now the bank has some comfort with the program, as does the hospital. And so everybody's usually willing to expand that out.
Okay. I imagine the bank relationship is probably with the accounts receivable team and a few other ones at the hospital, which is a pretty good place to be doing business, probably, right?
Yeah, and it's oftentimes in the revenue cycle management group, which is that group that's come about now that hospitals didn't used to charge patients very much, and now they're charging them a lot. So it's really
let's expand on that just a little bit. The balance is $10,000 for my surgery. Hospital pays $8,000. I'm on the hook for $2,000, and you actually have a different scenario of the way it actually works probably these days.
Yeah, so that used to be the way it worked, right? You paid your insurance premiums, and then when you went to the healthcare provider billed your insurance company, and the insurance company would take their discounts and pay the remainder of the bill. What's changed is in the last 10 years, high deductible health plans have become the predominant plan in healthcare. And what the difference is with a high deductible health plan is you have a deductible that you have to pay first. So to use our example that we've been tracking through, you go into the hospital, you leave with a $4,000 bill. The hospital will have received nothing from insurance other than an explanation of benefits that says, yes, Charlie is insured here, and Charlie now owes you $4,000. That's it.
Okay.
They haven't
because I've got a high deductible, I haven't climbed over it yet.
Yep, that's right. So if the hospital doesn't collect that $4,000 from you, they'll get nothing for that procedure. And the compounding part is that if you have a $4,000 bill that you haven't paid, the odds of you going into that hospital for any more service is very low. And if you paid the $4,000 and you go back in, now all of that is going to be charged to the insurance company.
Okay.
So the insurance company pays after your deductible's been met. So until you've met that deductible, the hospital hasn't made anything. Whereas in the past, they would do their primary billing of the healthcare or of the health insurance provider.
Yeah. And not that people don't honor these things, but I would imagine part of it is before I even get at that surgery, I'm signing something, and I guarantee it's saying I'm first on the.
Yeah, there's definitely a lot of legislation that's gone on, and a bunch of new forms that you fill out now about no surprise billing. I understand that I have a high deductible, and all of that is great because when you need health insurance or health service, you want to get through that process, right? You want to fill out the forms, you want to get in, you want to feel better. Then when you feel better and you get the big bill, you start to wonder, was this the right thing to do, right? And that's kind of a challenge. We once heard that there's 3 potential outcomes with care. There's poor service and an unaffordable bill, which is the worst, right? Yeah. That's just terrible. But a close second is actually good service and an unaffordable bill. And so, people would rather prefer poor service that comes with an affordable bill than good service with an unaffordable bill, because that keeps dragging on, right? Yeah. That's going to keep going into time. Whereas if you get poor service but you can afford the bill, you're like, well, at least it's over. Yeah, and you don't have to keep
one-time
suffering.
Event. Yeah.
Yeah, right.
Yeah. What's the third option? No service and a coffin? Or, what's the third one in there?
The third one doesn't really exist. That's great service and an affordable bill.
Yeah. I've never heard that one before. Good. Okay. All right. I want to talk a couple more items. The first one that comes to mind is delinquency. Do you have some understanding of delinquency numbers? And again, I know that there's a it sounds like a hospital backstop, let's call it, right?
Mm-hmm.
But let's talk delinquency and how you think about that in your space.
The way that we usually discuss it is in recourse. That means a loan has gone back. And what that means is, so if again we take our $4,000 example, the bank would remit $4,000 to the hospital. The hospital would wipe out the patient's bill, and the patient would have to make payments to the bank. If the patient stops making payments to the bank pulls back whatever's remaining. So let's say they've paid $1,000 and they still owe $3,000. The $3,000 bill gets reset at the hospital. So now the hospital's like, okay, you had a $4,000 bill, you made $1,000 worth of payments, but now you owe $3,000 again. And so in the worst case scenario for the healthcare provider, they're right back to where they were before. They have a bill, it's not paid, same situation, send it to collections, send it through. For the patient, they could sign up for another loan. They could try again. Maybe they need a longer term and less per month. We do allow those second chance loans to say, maybe I signed up for 2 years at 0% to pay $200 a month, and I couldn't really make that happen. Well, now I'm going to extend it out to 4 years at $100 a month, and maybe that's something I can do.
But one other subset of that, does the loan look like a zero interest to the customer? In other words, is it discounted on the back end to make it a zero interest loan on their end, or is it, are they also seeing an interest payment as part of that?
So it depends. Since we set up a direct relationship between the healthcare provider and the bank, every healthcare provider gets to decide if they want to pay some interest. So we have some that pay half the interest for the entire life of the loan. We have others that'll do 0% interest for 2 years, and anything past that carries the full interest rate of 10%.
I got you. It's like buying a couch.
Yeah.
Right. I think that's what they offer.
The point. That's part of the reason we like this. Part of the reason we like this so much is if you're buying a couch or a new air conditioner, there are great options for financing. But in the healthcare space, it's very limited. And again, to not beat our $4,000 example to death, but if you put that on a credit card and paid $100 a month, it'd take you almost 10 years to pay it off, and you'd pay about $7,000 in interest, right? And so if you put it on a loan at 10%, pay the same $100 a month, it's paid off in 4 years, and it only costs you about $800. So it's almost a factor of 10 more expensive to put it on a credit card. So the honest thing that patients need to have with themselves is, do I pay this off every month? If you pay your credit card off every month and you want points, by all means, that's a great way to do it. But if you're not paying it off every month, credit card interest, which is now averages 27.7%, is really brutal and can be really damaging.
Okay. Yeah, and I would. That's interesting, right? I mean, that's your main competition to some degree is credit card debt. So, right. I mean, that's the main motivator for that customer to get there. Okay. Last question I had was: is there I think you talked about possible positive relationship between the hospital and the bank, right? Obviously, a commercial relationship, but what about on the deposit side for the customer, for the patient, right? Are any of these guys coming on requiring a direct deposit relationship or anything along those lines to get this done? Or is there any positive chance to take on the primary account, I guess, of the patient?
Yeah, Charlie, there's a couple of things that we've seen. The first is the one we're probably most proud of, since we don't do any underwriting of the individual patient, every patient qualifies. We will report to credit positive payments. So if there's missed payments, we recourse it back to the healthcare provider. But if there's positive payments, people with low or no credit footprint can actually build a credit report. It's a much better way than some of these credit builder programs where you're just making payments for nothing. And so this is a medical debt you have. You make the positive payments, and you can build your credit score. And then the second, and so by doing that, somebody who is maybe not a viable bank customer becomes a viable bank customer in the future as a result of doing the loan. The second one is, like you said, just someone to market to. So now you're in front of this patient every month, and they're getting statements, they're getting information from you. It creates the opportunity for that bank to market other programs to it. And we have seen some turnover of customers from someone they never knew or never marketed to into fully functioning bank customers. And we attribute that a lot to people are under the gun, right? You have this $4,000 bill. You have no idea how you're going to pay it. You got 2 kids, and you never know when you're going to be in the hospital the next time. And if a bank, a local community bank or credit union, helps you out, you feel pretty good about that relationship. It's a really good way to start a relationship.
That's great. Yeah, it's good perspective. Okay, what is there anything I didn't ask you?
I think we got through most of the important stuff. It really is a situation. The healthcare providers who implement it, people who have to call and ask to get patients to pay their bill, it's a tough job, especially when you don't have any good options. And this just gives them a good option to say, hey, Charlie, you've had this bill for 4 months. I understand you might not be able to afford it. We have a program that you don't have to qualify for. You can just use if you want. Here's how it works. You can pay, if you got a $4,000 bill, you can pay $100 a month for 4 years, or you can pay, $50 a month for 6 years. And you can start eating away at that debt without taking on a lot of risk.
Oh, well, that's great. Okay, well, thank you, Jeff. I appreciate you joining us on Bank Talk today.
Thanks, Charlie. I appreciate the time.
All right, take care.
Thank you for listening to the Bank Talk podcast brought to you by Remedy Consulting. To reach out to Jeff at Epic River, go to epicriver.com. Once again, epicriver.com. We are producing video podcasts on YouTube, so you're welcome to join us on YouTube under Remedy Consulting's channel. Thanks again, and we'll see you in the next episode.